Hello and welcome back to The Note. Well, it's a new dawn in Washington. We now know, as many had expected, but not with total certainty, that the nightmare scenario of a technical default on US Treasuries has been averted. It looks like a big victory for the president and a big defeat for the Republicans in the House of Representatives who had been driving the issue. What does it mean for markets? How should we be allocating assets after this brief crisis? With me now to discuss this is the CIO for fixed income at Axa Investment Managers, Chris Iggo. Chris,
hello.
Thanks very much for joining me today. Let's start by taking a look at 1 month T-bill yields, and this was perhaps the only asset class where you could really see that some risk of a default ever showed up in prices. How seriously did people really think that the technical default could have happened?
Well, I think most level-headed people didn't think it would happen. There was very, very little chance of it actually going to the wire. But I guess that some investors needed to be prudent and manage their risk accordingly. And we did see quite a lot of activity in the auctions recently, in the Treasury bill auctions. Investors wanting to avoid the bills that were maturing around the time then when we may have hit the deadline for a default.
But if we take a look at the slightly longer term scenario where we're looking at the exchange rate of the dollar on a trade weighted basis, that's the red line, and yields on the benchmark 10-year treasuries, did any risk of a default ever really show up in those prices, do you think?
No, I don't think it did. And I think part of the reason was people really didn't know how to trade this risk, because if there had been a default, you could have made a very strong argument for treasuries going up because of the safe haven flows that would still take place going into the US market, especially if there was perceived to be an economic risk resulting from this. Or you could equally make a big argument for treasuries going down because of the credit risk aspect. When we look back on the charts, I think this will be a very small blip.
Now, but it is interesting that the dollar somehow or other managed to fall quite badly today, which does suggest that some of those perverse safe haven flows you were talking about might have happened, that people were marching for the safety of the US, even though the centre of the problem was the US.
I think that's right, and I'm sure there were some of those flows. I think there's a little bit of buy the rumour, sell the fact as well now that a deal has been reached. It'd be interesting to see how the dollar does trade going forward, because of course we haven't solved the problem of the debt ceiling and the budget. We have to revisit that again in January, and meanwhile we've got the Fed to think about, and if the Fed continues with QE, then maybe the dollar will go lower.
Right, and presumably it's fair to say that the Fed matters a little bit more than the imbroglio between the Congress and the presidency.
Well, it depends on the time horizon. I think now, between now and year end, it's definitely all about the Fed. We haven't had any data since the government shut down, so that's a little added uncertainty in the outlook. But I think the Fed will take the view that there's no need to rush into tapering. They can keep buying treasuries throughout the end of the year, particularly if there's still this risk that political uncertainty will reassert itself at the beginning of 2014.
Now let's take a look at what's happened to equities. If there's a market which really showed the importance of the Fed, so we have a very big dip in June when people were worried about tapering, and a much smaller dip recently, which I think probably was driven in large part by the political uncertainty of the last few weeks. Overall, do you feel comfortable with a trend line which seems to be quite so emphatically upwards?
Yes, I do. I think this reflects the greater confidence there is on the global economic outlook, and particularly in the US. We've seen strong numbers up until the government crisis. I suspect we'll continue to see fairly strong numbers through the end of the year, although there'll be a bit of volatility around the period where the government was closed down. But I think we should see a fairly strong rally into the end of the year from equity markets.
And I guess my final question, even if the credit risk isn't a factor in the US Treasuries market, are you comfortable with the price of US Treasuries at the moment? Are you long or short US Treasuries?
I think the yield is still pretty unattractive, and the next big move is up in yield and down in price. So we're underweight US Treasuries, we're underweight US fixed income as a whole. But this is for positive reasons. We think the economy is strong and that ultimately interest rates are going up.
Okay, Chris, thank you very much indeed. I think the conclusion is fairly straightforward. There was a very small risk that something very terrible indeed would happen. It didn't. Now we can move on to the game that we've all been playing for perhaps too long, which is trying to second guess the Fed and how and when it is going to exit from QE.